If you're a business owner, you already know your financial life doesn't look like everyone else's. Your wealth is tied up in your company, your taxes are more complicated, and your retirement plan isn't just as simple as contributing to an RRSP. The truth is, most advice out there isn't built for this reality. It often only focuses on one piece of your puzzle, like investments, insurance, retirement savings, but not the whole picture. And that's why business owners need a different type of planning, a system that integrates your corporation, your personal wealth, and ultimately your long-term goals. And that's what the Total Wealth Strategy is designed to do. So what makes you as a business owner unique? Well, for one, most of your wealth is in your company, not in personal accounts. Over the years, as your retained earnings grow, you're dealt with a passive income grind impacting your small business deduction. There's no employer pension, so you need to design your own retirement income plan. Then there's succession planning, which often involves family, employees, or a sale. And then there's risk management, which isn't just your personal affairs. It also includes protecting the business and its key people. It's a lot of moving parts, and if they're not connected, the result is inefficiency, higher taxes, and missed opportunities. So where are the gaps in traditional advice? Well, most advice only looks at one piece of your puzzle. Investments in your corporate account, an insurance policy sold years ago, maybe an RRSP contribution strategy, but who's connecting it all? Without proper integration, it's common to see corporations paying unnecessary tax on their passive income, owners overfunding RRSPs when an individual pension plan would be better. There's no plan for extracting wealth tax efficiently. And then you have your estate where CRA ends up being the biggest beneficiary. So let's talk about the cost of fragmentation. CPA Canada warns that mismanaging passive income can add tens of thousands of dollars in tax each year. And then we have Financial Planning Canada research that shows that business owners without written plans are far less confident about their retirement. Then there was a study by Moore and Chappell that found that coordinated succession planning can preserve 20 to 30% more enterprise value. The numbers are clear. Integration isn't optional, it's essential. So how does the Total Wealth Strategy try to solve this? Well, the Total Wealth Strategy takes a holistic approach that connects both your personal and your corporate wealth. It typically includes corporate planning for your investments, managing your passive income grind, helping you determine the best course of action for taking salary or dividends, helping you understand the pros and cons of different pension plans like an individual pension plan, retirement compensation arrangement. And then there's a personal planning for your RSP, TFSA, and any non-registered holding. Can't forget about insurance and family business protection, as well as your retirement and wealth planning that integrates both corporate and personal assets. And then the succession planning, whether it's for a sale, transition, and we can look at strategies like estate freezing to lock in your overall value. And then having a very important coordinated strategy between your existing lawyers and your accountants. Having tax integration that aligns both your corporate and your personal tax strategies. Planning withdrawal strategies to reduce lifetime tax as opposed to just 1 year. And this professional coordination ensures that both your accountants, lawyers, insurance specialists, and financial advisor are all working with the same playbook. So I'll give you a case study of how I helped a client implement this strategy. I had a business owner who had $1.8 million inside their corporation, as well as RSPs and TFSAs. They were only taking dividends, reinvesting passively into the corp, and had no succession plan. After going through the planning process, we determined they should restructure and have a balance of both salary and dividends for tax efficiency. We added in an individual pension plan to give them a defined benefit style pension. We reallocated the investments within their corporate investments to reduce their passive income grind. And then we worked with their accountant and lawyer to set up an estate freeze to protect their family wealth. The outcome was lower taxes, higher retirement security, and a clear succession plan. We were working with the same resources, but gave them an integrated strategy built for business owners. So if you're a business owner, ask yourself, are your corporate investments costing you small business deduction room? Do you have a plan for extracting wealth tax efficiently? Do you have a written succession or exit plan? And is your accountant, lawyer, and advisor all working together, or are they doing their own thing separately? If you're not sure, you have a planning gap. And here's how to close it. Download my business owner playbook. It's a practical guide that shows you how your corporation, personal wealth, and long-term goals can work together under one coordinated plan. The link's below. As always, thanks for watching. Stay tuned for more videos. Take care.